Here is the claim that most people still refuse to say out loud. The next silver event will not begin as a rally. It will begin as a controlled-looking liquidation, fast, ugly, seemingly rational, because the modern dollar system doesn't resolve stress by pricing assets correctly. It resolves stress by forcing collateral into the market at the exact moment liquidity is vanishing. That is why you can see silver flash crash toward levels that feel absurd, $15 to $60, whatever the print is, right before it flips and explodes green in a way banks cannot contain. Not because silver is magical, because the plumbing is mathematical. Recent estimates put global debt around the mid-$300 trillion range when you combine sovereign, corporate, and household liabilities, and layered on top is an even larger stack of derivatives and FX swaps that behave like debt when funding tightens. Roughly speaking, that is an ocean of claims that must be rolled, priced, margined, and refinanced inside a system whose core fuel is the dollar. When that fuel becomes scarce, the system does not slow down. It seizes, and it seizes in stages, the same way it has seized in every prior era. First, the foundation is built and trusted, then expansion stretches it beyond its design limits, then a crisis reveals who was swimming naked, and then the inevitable outcome is a repricing of the settlement asset, money, against everything that was promised. This is not a mood, it is a mechanism. The public sees charts, professionals see balance sheets. But the real story sits between them, the collateral chains, the funding markets, the auctions, the FX basis, the hedges, the paper claims that pretend to be equivalent to physical. In the dollar regime, almost every global actor, bank, insurer, pension, commodity trader, sovereign, ultimately answers to the same question. Can you source dollars at the margin when stress hits? If the answer is yes, risk can be carried, spreads can be warehoused, and volatility can be sold. If the answer is no, assets must be dumped, not because they are bad, but because they are liquid enough to sell. And in that forced selling sequence, silver and gold behave in a way that shocks retail minds. They can drop hard at the start of a funding squeeze, even if the endgame is bullish. That apparent contradiction is the signature of the liquidity trap. Think about what dollar shortage means in practice. It is not that the world literally runs out of green paper. It is that balance sheets shrink, repo haircuts rise, banks widen bid-ask, and the cost of swapping local currency into dollars spikes. It is that every hedged position suddenly needs more margin. It is that a treasury auction clears with ugly tails and weak bid to cover, and risk managers respond by cutting. It is that funding markets stop being a smooth highway and become a toll road with gates. In those conditions, the market sells what it can, not what it should. Silver, being smaller, more volatile, more levered in paper markets, gets hit first. It is the collateral pawn that gets tossed on the table. And then, once the sell-off has transferred real metal into strong hands, or once shorts realize delivery risk has changed, silver becomes a pressure release valve. The crash is the setup for the squeeze. To understand why this sequence is predictable, you need to define the fixed pattern that keeps repeating across eras, regardless of the exact instruments. Every monetary order begins with a foundation that looks stable, a credible anchor, a trusted settlement system, a set of rules that make credit expand safely. That's the initial architecture. How money is created, how claims settle, how trust is enforced. Then comes expansion. The same stability that attracts capital also invites leverage. Debt grows faster than income. Promises multiply faster than reserves. Policymakers discover they can smooth downturns by extending credit and compressing volatility. Over time, the system trains everyone to believe liquidity is permanent. Then comes crisis. Some shock, war, inflation, banking losses, a broken peg, a political decision, reveals that the system cannot honor all claims simultaneously at the promised terms. And once that loss of control becomes visible, the inevitable outcome arrives. The anchor is redefined, purchasing power is reset, and the settlement asset reprices violently against what was overissued. That repricing can happen through devaluation, inflation, default, financial repression, capital controls, or a combination. But it always happens. That is the math. If liabilities outgrow the real ability to service them, the unit of account must change in value or the claims must be broken. The reason people miss it is because they confuse money with policy. They think if central banks want stability, stability will happen. But central banks do not control outcomes, they control constraints. They can choose which segment of the system absorbs pain first. Bondholders, currency holders, taxpayers, banks, or savers. They can shift the burden. They cannot delete the burden. In a dollar-centered world, the burden often shows up first as FX stress, because global actors must convert local pain into dollar obligations, and then as funding stress, because hedges become expensive precisely when they are needed most. That is why you often see the same cinematic progression. Dollar up, currencies down, yields jump, volatility spikes, commodities whip, And then metals, especially silver, do the violent two-step, down in the liquidation phase, up in the credibility phase. Now prove it with history, not vague analogies, specific decisions, specific years. And the same mechanism, start with the post-World War I order and the consequences that followed. The war shattered balance sheets and forced governments into debt structures their pre-war monetary frameworks could not support. Europe emerged burdened with obligations, reparations, and political instability. The United States emerged as a creditor with growing monetary influence. The foundation phase here was the attempt to restore a gold-anchored discipline and a pre-war normalcy, a return to gold standards and fixed convertibility that promised stability. Britain, for example, famously returned to gold in the mid-1920s at a parity that many economists argued overvalued the pound, and other nations tried to stitch their currencies back to gold to regain credibility. That restore the old anchor strategy is what a foundation looks like, an effort to reestablish trust through a hard rule. But then came expansion and overextension, and it arrived through two channels: credit and cross-border imbalances. The 1920s saw rapid credit growth in the United States and globally, and it also saw a web of international payments and debts that depended on continuous capital flows. Germany, facing reparations obligations, relied on foreign lending to finance payments and stabilize its economy. This was the expansion stage, a fragile structure held together by rolling claims. It worked as long as confidence and liquidity flowed. It is the same as any modern roll, just with different instruments. The system grew more levered, more interconnected, and more dependent on continued funding. Then the crisis stage hit. When global conditions tightened, market stress, capital retreat, banking strains, the fragile funding chain snapped. The Great Depression era isn't just about stock prices. It's about the breakdown of convertibility and payment systems under deflationary pressure. Deflation is not a neutral lower prices story. It is a debt amplifier. If debts are fixed nominally and prices, stockholders' incomes fall, the real burden rises. That is crisis mechanics. Under the gold standard constraints, central banks and governments had limited ability to expand monetary conditions without risking gold outflows. So countries faced a brutal choice: defend the peg and crush domestic economies, or abandon the anchor and admit the foundation can't hold. Britain left the gold standard in 1931, a concrete decision that illustrates the loss of control moment. The rule that defined the system was no longer sustainable. In the United States, the early 1930s saw banking failures and deep deflationary pressure, and the government ultimately moved to change the monetary anchor, ending domestic gold convertibility and later raising the official gold price in 1934. That is the inevitable outcome stage: a reset of the anchor, a repricing of the settlement asset, and a transfer of purchasing power. The lesson is not gold is good. The lesson is, when the foundation cannot support the expanded claims and deflation intensifies the real debt burden, the system must re-anchor. You can call it policy. It is, at root, arithmetic. Now look at the second case study. The late Bretton Woods breakdown and the 1970s stagflation. This is the cleanest demonstration because it sits right on the dollar. The foundation phase was Bretton Woods itself after World War II. The dollar is the central settlement currency, convertible into gold for foreign official holders at $35 per ounce, and other major currencies pegged directly or indirectly to the dollar. This created a stable global framework for trade and rebuilding, with the United States at the center. Trust was anchored by gold convertibility, at least in theory for the official sector, and by America's post-war industrial dominance. The machine looked stable. Then came expansion. As global trade and financial flows grew, the world demanded more dollar liquidity. The U.S. ran deficits at various points, including major fiscal pressures in the 1960s, and exported dollars into the global system. This wasn't a moral failure, it was an inherent contradiction. If the dollar is the world's reserve and settlement asset, the world needs more dollars as it grows. But the more dollars you export relative to gold reserves, the more the promise of convertibility becomes suspect. This is the overextension stage. Claims to dollars and dollars to gold convertibility expanded faster than the physical reserve base. It was the original paper versus physical problem, just in a different asset. Foreign central banks and governments accumulated dollar claims, and the pressure on U.S. gold reserves intensified. Then crisis. Loss of control became visible when foreign holders began to demand gold, draining reserves and stressing credibility. This is where the mechanism becomes explicit. In August 1971, the United States suspended gold convertibility, the Nixon shock. That is not a footnote. It is the textbook example of a foundation rule breaking under expansion. Once convertibility ended, the system's anchor was gone. The immediate aftermath involved currency realignments, attempts at new pegs, and ultimately the transition to floating exchange rates. And what followed in the 1970s was not just inflation happened. It was an inflation transmission cycle through FX and commodities. A weaker dollar, oil shocks, wage price dynamics, and policy responses that lagged behind inflation created a stagflation environment, slow growth with high inflation that punished both bonds and currency holders. Bond yields rose as inflation expectations reset. Volatility increased as markets relearned that policy could not simply declare stability. The inevitable outcome stage here was the repricing of money itself and the reassertion of hard asset signaling. Gold surged through the decade, reaching dramatic highs by 1980 as confidence in fiat purchasing power eroded. Silver, notoriously more volatile, experienced its own explosive dynamics in the late 1970s and around 1980, tied to both monetary stress and market structure, including concentrated positioning and physical demand pressures. The important part for our purpose is not the personalities or the headlines, it's the structure. The foundation rule, dollar to gold convertibility, could not survive the expansion of dollar claims. When it broke, the system did not gently rebalance. It reset through inflation, FX adjustments, and a violent repricing of real assets and yields. That is the pattern. Now bring it forward to why silver can flash crash first in the modern era. Today's foundation is not a gold peg. It's the dollar-based collateral system. U.S. Treasuries as the base collateral, repo markets as the transmission belt, the global banking network as the distributor, and derivatives, rates, swaps, FX swaps, futures, as the leverage layer. This foundation looks boring, but it is the entire world. Treasuries are not merely government debt. They are the reference asset for collateral valuation, liquidity buffers, and pricing of risk. When the system is calm, treasuries are risk-free and funding is cheap. That calm invites expansion. Duration is stuffed into portfolios, leverage creeps in through basis trades, dealers warehouse risk, and everyone learns to sell volatility because it keeps paying. Credit spreads compress. Emerging market borrowers load up on dollar debt. Corporations refinance. Governments run larger deficits because financing seems painless. The expansion phase is not a single decision. It is a collective behavior encouraged by low rates, abundant liquidity, and the implicit promise that the dollar funding market will remain functional. The crisis phase in the modern system announces itself through funding stress and FX basis stress before it announces itself through headlines. You see it in the cost to hedge dollars. You see it in repo specials and fails. You see it in treasury auction indigestion, tails, weak bid to cover, indirect bidder shifts, the market demanding higher yields to absorb supply. You see it when yields rise, not because growth is great, but because term premium and supply pressure collide with reduced balance sheet capacity. That is the moment the machine reveals itself. If yields rise, while liquidity falls, risk assets can't breathe. Volatility spikes because the discount rate and the funding rate are moving together against you. And in that stress window, commodities and metals become a mirror. Paper gold and paper silver trade as financial instruments. First, futures contracts, options, ETFs, unallocated accounts, swaps. In a funding squeeze, those instruments behave like everything else. They are collateralized exposures that can be reduced quickly. So the first move can be down, a liquidation wave that forces weak hands out and triggers stop-loss cascades. Silver, being thinner and more violent, is the perfect victim. It can print levels that feel like a flash crash because paper can be sold in enormous notional sizes relative to physical float in a short time window. That's the paper versus physical asymmetry. Paper can expand and contract at the speed of margin calls. Physical cannot. But here's the part the system hates. Physical delivery is not a narrative, it's a constraint. When stress is high and trust is low, some holders stop accepting paper promises as equivalent to metal. They demand delivery, or they pay up for immediate physical availability. Premiums widen, inventories draw down. The price you see on a screen and the price to acquire real metal in size can diverge because one is a leveraged derivative settlement mechanism and the other is a supply chain. In silver, that divergence can become acute because industrial demand is real, mine supply is relatively inelastic in the short run, and above-ground inventories that are truly available, not spoken for, not leased, not pledged, are smaller than casual observers assume. When the market is calm, that doesn't matter. When the market is stressed, it matters violently. That's why the liquidity trap is not a contradiction. It's the signature move. The crash phase clears paper leverage and forces metal out of speculative hands. It also creates the illusion that metals failed as hedges, which is exactly what you expect in the crisis stage of the mechanism. Then, as the system approaches the inevitable outcome stage, when credibility in the unit of account is questioned, when policy must choose between defending currency value and defending funding stability, metals reassert their role not as investments, but as monetary pressure gauges. Gold typically leads because it is the pure monetary asset. Silver follows with torque because it is both monetary and industrial, and because the paper market structure is more susceptible to squeezes and delivery anxiety. The very leverage that made it crashable makes it explodable. You can feel the inevitability building because the constraints are converging. The US must fund large deficits through continuous treasury issuance. That issuance must be absorbed by a market whose balance sheet capacity is not infinite. If private demand is insufficient at current yields, yields must rise to clear auctions, unless a buyer of last resort intervenes. If yields rise too far, risk assets wobble and funding strains intensify. If intervention caps yields, currency credibility takes the hit through inflation expectations or FX weakness. Either way, something pays. That is the mathematical structure of an overextended system. You can shift the pressure, you cannot remove it. And when pressure reaches the metals complex, the distinction between price discovery and liquidity discovery becomes everything. In the early phase, futures price discovery dominates because it is liquid and leveraged. In the later phase, physical liquidity dominates because it is scarce and demanded. That transition is where the violent green candle is born. It is not that banks lose control because they forgot how to trade. They lose control because the collateral logic that allows paper to substitute for metal begins to fail at the margin. When enough participants insist that only delivery settles the argument, the market stops being a chart and becomes a supply chain. This is why the silver story is never just silver. It is the dollar system telling you what stage you're in. A flash crash is not a sign that the thesis is wrong. It is often a sign that the system has moved from expansion into crisis, and crisis always begins with forced selling. The rally that follows is not sentiment. It is the market repricing the cost of trust. Gold will be there in the background, doing what gold does, tracking the credibility of money. Silver will be there in the foreground, doing what silver does, exposing the stress points in paper claims, inventory, and delivery.